All right, let's start talking a little bit about LEAPs now. LEAPs are long-term equity anticipation securities. Like I kind of gave you a brief little teaser there. These are a great way to use leverage, take advantage of the moves in the marketplace. Let's dig into it. Using long-term options as a substitute for stock. Now, number one, it says here that 100% of option premium is at risk. These are options. Consequently, you're going to invest in a wasting asset. Let me give you a little analogy, okay? This was given to me a long time ago, really helped me understand, okay? Remember, all options are wasting assets. They're all ice cubes, okay? What the kind of the goal is, though, is increase our education so this incredible leveraged vehicle can be used to benefit us and our, us and our families. So imagine this. Imagine here's the ice cube, just at being the nature that it's an option. It's decaying, it's melting. If this is expiration, that's the heater. Well, as that ice cube moves closer to the heater, it then decays or deteriorates even faster and faster. Well, if this is expiration, here would be the parallel by using LEAP options. Well, you go right over here and you say, well, I'm going to buy an option way over here. So I know that it's still a wasting asset, but it's so far away from expiration that, and time is moving on it, so it's slowly decaying, but not that bad at all. All we'll need to do is generally guess and forecast the general direction of the market. And we now have access to the same leverage. It's still wasting away, but very, very slowly. My parallel, it's like putting on a very cold glove and holding the ice cube. It'll melt a lot slower than your skin, So yes, eventually, sure, it'll go ahead and melt. But for this circumstance, LEAPs are very, very useful. In fact, if you have smaller accounts, $1 million or less, well, that's how he says. How about, let's say, $10,000 or $20,000 or less, okay? Fine, we all had to start somewhere. I started with a little under $5,000, okay? $4,700 is what I started with. So if you have $10,000 or $20,000 or less, a smaller account in the grand scheme of things, LEAPs are a fantastic way to be working our system, okay? Again, to generally be right in the general direction of the market, okay? Time decay, that's kind of my little analogy on time decay. Again, it makes sense. In fact, one of our alumni students emailed me this, said, well, listen, I want the leverage, but I don't want the time decay. Unfortunately, then we don't have a match, okay? In order to get, we have to give something. In order to get that powerful leverage, we must give something. And so what we're giving is a little bit of time decay here. Let's talk about the advantages of LEAPs. First of all is leverage. Ladies and gentlemen, fast becoming. After this class, you'll know that leverage is going to be probably one of your favorite words. Remember, cash flow is number one and leverage is number two. You will soon seek out leverage in most of your transactions. You'll realize that if you're not using leverage in your transactions, leverage is being used on you. For example, if you work for a company for X dollars an hour, whatever it may be, that means basically you are somebody else's leverage. No offense, I've worked for plenty of companies, okay? But leverage is a key part of success. Now that said, your employer's job is not to make you rich. Remember, their job is to pay you for your time. It's your job to learn how money works and get rich, build a business, increase your financial IQ on your own time. All right? So again, leverage, very, very important part. Why the 5% control 95%? They have the leverage of financial education. They've learned how these things work. Less capital than buying shares. You'll need much less capital than buying stock outright. In fact, I'm going to introduce this concept as I've done before. Many of you folks will realize that, wow, if I can have access to leverage plus LEAPs, why would I buy stock? I'm going to revisit that in a little bit and see what you think. Closely follow the movement of the underlying stock. It's called a high delta. Delta, remember the Greek symbol delta? It's a triangle. Delta, that means rate of change. Rate of change. We're going to go over that in a future slide, just kind of the advantages here. And a viable substitute for stock ownership. So yes, when you do a search and you find a really great stock, of course, you can buy the stock. If you want to use the leverage vehicle of LEAPs, you're welcome to. Now, we're going to go over how many LEAPs are available on what stocks. There's not LEAPs on all stocks, but they are very, very popular and becoming more and more popular, might I add. This allows more time for the stock to move into a profitable position. So if we can use our system to go ahead and forecast where we think the stock will be, we use the leverage vehicle of the leap in order to help us get there faster. Well, let's give you an example. Right over here we have Microsoft. Maybe you've heard of the company before. Right over here we see that the stock is going from, about $55 a share on up. It reached a high of about $75 a share. That's about a $20 move. That's a great move for a stock. It's 40%. In that same period of time, take a look at what the leap option did. In that same period of time, that $20 move then produced a $12 move, which was a 100% move on the option. Now, folks, if you do me a favor, let's go ahead and focus on this slide. Everybody take a look at the slide, and if you look at that, you can see that it's generally almost a mirror image. Look at the top chart and look at the bottom chart, and you'll see that those are darn close to being a mirror image of one another. So if, in fact, we have a leverage of movement with the delta, the rate of change is appropriate, why not go ahead and use the leverage way to get in, okay? Well, let's take a look at the downside as well. This is exact opposite movement. So you'll see right over here in Juniper Networks, that's moving down and the option's moving up. Well, in that case, guess what kind of option we have? Not a call, but a put. Again, I know I've talked about puts here for a good portion of the day, but here's a good way to think of puts. Puts are on a teeter-totter with the stock's price. So for example, we have a stock over here and a put over here. The stock goes down and the put goes up, all right? That's an easy way to think of it. Puts are on a teeter-totter. So sure enough, let's take a look at this teeter-totter. As you'll see, the stock price is heading down. On the other end of the teeter-totter is the option. In this case, it's the $80 put option. It is then rising up. A $100 move on the Juniper Networks, negative 83%. Wow. Produced a 175% move on the option premium. Again, this was kind of during the heyday a little bit, but folks, if you can guesstimate, if you can forecast the general trend of things, you can do very, very, very well. Identifying leaps. How do we identify stocks that have well-priced leaps? Well, there's leaps on only 450 stocks, not 12,000. And about 10 indices or indexes. Different option symbols than regular contracts. They're different options. So it's just a regular contract, just like a stock certificate. This is an option certificate, okay? It has different option symbols, different option root symbols. They do all expire in January. That's the little bit unique part. All leaps expire in January. All leaps also have 7 months or more prior to expiration, which means, let's say it's, for example's sake, it's February, all right? And that means the next, let's say it's 2004. 2004, February 2004, all right? The next set of leaps that are out there are, they know we have to be January, and there must be 7 months, okay? So it's January 2005. We also very well have some January 2006 that are getting written, okay? There's usually up to 2.5 years of leaps that are written. Now, as soon as it becomes within that threshold of 7 months, so what is that, June, July, August, is that around there? So as soon as that January option, it's really just a January option, it's called a leap because it's further than 7 months. As soon as July clicks over, then it's within 7 months, and then it becomes we just call those the Jans or the Januaries. We'll just say, hey, I'm picking up 10 contracts of the Jan-Oct 30s, okay, the Jan-October 30s. That's exactly what it is. They just become the Jans or the Januaries, okay? Then, right around that June, July time, is then you'll see the next year getting written. Remember, 2.5 years? Then the 07s will be getting written right around there, 2.5 years out. So we have 7 months or more of options. Usually they're 2 years of leaps. You will not find leaps on many stocks. The GEs and the Microsofts and the Ciscos and the Home Depots and things like that, those are fairly easy. You're comfortable with those names. pimentoloaf.com. I don't know if that's a real company. Of course, you're not going to find a leap on that company, okay? It's the mainstream. A lot of the Standard & Poor's 500s, the Dow 30s, the Disneys and the Philip Morrises, things like that. If you're generally bullish over a longer term, the leverage vehicle makes perfect sense for you, okay? All right, let's go ahead and get into how we go ahead and take a look at these and how we trade these. Well, we'll go right over here to the list on the bottom left-hand side of the strategies page. Remember, everything we're talking about here on these DVDs on the website, easy to find underneath mainly the strategies page. The left-hand side here, we have a list of all of the available leaps. Next, we have screened list of leap calls. Again, these would be our computer list of stocks that would be favorable candidates for leap options. Calls, that is. And over here we have a screened list of leap puts. If you own a stock, I would hope your stock is not on the leap put lists, because that would mean we're overall bearish on the stock by using a leap put to take advantage of that. Let me use a little story here, folks. There was an example of this was used in class. We used this. Don't quote me on this. So 2002, late 2002, I believe. Don't quote me on that. But there was a lawsuit that came out on a famous smoking company that makes Marlboros. Okay, I forget the name of the company now. Philip Morris, right? And they had what's called a class action lawsuit. Now, if you don't know about class action lawsuits, that's generally bearish. Okay, if you get a class action lawsuit, that's generally not a good thing. Well, sure enough, the stock hit about $55 a share, 3 flaming red arrows, and high volume on the downside. People were selling their stock and very, very nervous about this class action lawsuit. Well, the investor, most of us, would then just go ahead and sell our stock on the 3 red arrows and broken support. Well, that's fine, and that's good enough. However, if then these news stories keep coming out and coming out and coming out as they did, maybe the little bit more proactive investor can say, hey, listen, if I were an institution, I would want to limit my exposure to a company that's currently in the trenches of a class action lawsuit. That logically makes sense to me. So instead of shorting the stock and causing those margin requirements, I'm going to go ahead and look for a leap put, which means you're going to have a general forecast that the overall stock is going to be in a downtrend over the next year or 2 years. The maximum you want to invest is the max you could lose. So the stock is $55,000. Let's use a round number. $5,000 you could spend on a leap put. And let's use, since we're experienced with these strike prices, let's say we use this on a $60 strike price. Okay? I'm just going to kind of make these up as I go along to illustrate my point. So the stock's heading down. It's a $55 stock. We're going to invest in the $60 leap. We have the right to put the stock to somebody else at $60 a share. Well, I don't know the exact price it went to, but it went to well below 30. All right? So let's just use 30 as an example. That $5,000 that we have then became worth at least $30. What's 60 minus 30? It's $30. So that bearish forecast produced $30,000 in gross profit. Subtract the $5,000 that we used to buy the option, we have $25,000 in gross profit. Again, this is just using a leverage example. Some of you are sitting at home thinking, wow, I could have easily picked stocks that were heading down. Just look at my portfolio, So that said, hey, instead of doing this, again, that was when you were pre-educated, all right? You're not educated. Now that we understand leverage, it's a necessary part of your toolbox, okay? Your toolbox or our investor toolbox. Let's go ahead and use those. Conversely, on a bullish angle, if you notice a stock is doing very, very well, instead of going ahead and buying an option that expires in maybe 1 month or 2 months, maybe use, statistically, maybe a larger portion of your portfolio. Instead of $2,000 or $3,000, maybe a larger portion, whatever that may be, and then buy a leap option. I've had several of our students do this on companies that have come up on our searches. Companies that have already doubled their price over the last 6 to 12 months. And it is breathtaking to me to see people who are just ordinary people, like you and me. If you're like me, I kind of always thought at a certain age that I started, getting good at this stuff, I kind of thought I'd be worth more, And then I learned, I said, hey, I didn't have the skill set, so that's fine. And I've taken students to that point too. They come to our class, they realize they always needed to learn about options and they needed to learn about stock. And they're sick of giving their money to somebody else. And they realize, gosh, if I would have known this stuff years ago, where could I be now? Where could you be now? All right? We'll revisit that at the end of the day. But again, I'm just really passionate about LEAPs, and I'm passionate about the leverage that they offer. Well, we go right over here, and here's the screen list of LEAPs themselves. We see right over here we have the calls. All these are call LEAPs, okay? All these are calls. Here's the group that it's in, the banking group, whatever, the data service group, that's computers, et cetera, all the way down here, okay? And then here's the stock. Providian is the first one. Well, that is a good place to begin your research. That is a good place to go ahead and begin your research. You would need to evaluate those stocks, Providian and FE, UBS, all the way down here, Washington Mutual, SBC, all the way down here, to find out if this interests you and it passes your phase 1, phase 2, industry group. We have the neighborhoods moving up, big charts favorable, et cetera, et cetera. But that's basically what we're looking for, a screened list of our LEAPs. Well, in fact, this one right over here, has anybody ever heard of McDonald's? Nobody in this room, I'm sure, but has anybody ever heard of it or driven by one ever? Yes or no? Yeah, I know you guys are all, Atkins people, right? Me too, right? I never eat any of those fattening foods, but McDonald's, in fact, and they have some really good salads now, don't they? There was a book that was written that this guy came out and he ate. Don't laugh at that. This guy came out and he ate McDonald's for a month. Every breakfast, lunch, and dinner, all he'd ate anytime is McDonald's. And he gained all this weight, it's the worst thing in the world. And McDonald's rebuttal, rightly so, says you don't have to eat we do have some French fries, we understand it, but we have fantastically healthy things too. You don't have to eat all this stuff. And that's when the book Fast Food Nation became very popular. Then the baby boomers became very interested in health, Atkins diet. Now there's actually a Atkins Whopper. Doesn't that sound like it's kind of defeating the purpose a little bit of a Whopper? But call me crazy. Anyway, let's go over here on McDonald's and take a look. Well, you have a good-looking stock. In fact, let's take a look at the stock right over here. McDonald's is right over here. By the way, the FFF, that stands for fast food. I know that from trading some of these stocks in the past. You don't need to memorize those, by the way. There's about 240 of them, but just for my history. And then we see the stock let's see the stock price. The stock closed at $24 a share. And this LEAP that it's highlighting is let's scroll over here, it's the $15 call. Well, the key thing to understand before you invest in the $15 call is the delta. The delta of the option, how that affects the price of the movement of the LEAP. Well, this measures the relationship between the option contract and the underlying stock, stated as a percentage in between 0 to 100. Shows how much an option will move for every dollar move in the stock. An at-the-money option typically has a delta of around 50%, or 50% for every dollar the stock moves. Again, let me take a look at this little visual here. Delta, rate of change, stock move, option move, okay? So stock move, option move, stock move, option move, okay? That's the rate of change. Ideally, if you have a delta of 1, all right, you have a 1-to-1 relationship. So let's say it's $30 a share, 31, 32, 33, 34. It moves in sync. That would be a delta of 1. Well, if you have a very, very, a poor delta, let's say it's a delta of 20 or 20%, the stock moves $1, the option only moves 20%, okay? That's very difficult to make money like that because the stock has to move exponentially or excessively in order to make money. Well, now that we understand a little bit about that delta, how can we use it to serve us? Well, you go over here underneath graphs, click on McDonald's, and we see the option Greeks. We're looking